Karen Lin. I'm recording a video for a study guidance of Week 3 Financial Accounting. This week we are covering Chapter 3, some of the accounting techniques, including journal entries, posting, general ledgers, and the trial balances. So accounting is a system that we organize data together to create a system to show outsiders the information of a firm. So as we talked about in chapter 1, there are two main functions of accounting. One is the bookkeeping. We are keeping a record of all the transactions. And the other is reporting. We are showing all the transactions in a summary to the outsiders. So today I'm going to introduce a couple of the techniques that we need for bookkeeping. The first one is called the chart of accounts. It is, by its name, we know it's kind of like a chart showing all the accounts names and the account number. So each account names is corresponding to an account number. Um, the chart of account is sort of like a guidance on what kind of accounts that a company has and the numbers that associated with the account so that you could use it as a reference in the future. Notice in this chart of account, there's no numbers, I mean, in terms of amounts, because it's sort of like the higher level guidance for our bookkeeping. You can also see that all the accounts are organized in the order of assets, liabilities, stockholders' equity, revenues, and expenses. We put dividends as a part of the stockholders' equity. The second technique we are going to use is called the general ledger. A general ledger is a file of all accounts in which a company could store the accounting data. For example, we need a book to keep all different accounts. So a general ledger would look like this, and it could take different forms from in different companies. But it's a book of keeping separate accounts and showing all the transactions of that account. I'm not sure whether you have to your own financials at home. If you have accounting book at home, like you have a journal to keep your accounts, um, or some of the nowadays the trendy bullet journals. Some people keep their financial activities journals. It would look similar to this one. So it shows basically an account name, for example, cash, and it has some sheet numbers, account number. Now, account number of cash is 111 from the previous slides. We see that cash is 111. So in a journal, you would show the account's number, the account, and then the date and the description of all different transactions. The journal reference is just referring to your journal entries, which I'll talk about in a few minutes. And then you can see some debit amounts and credit amounts and showing the balances. So this is just like you are keeping your own book. For example, your checkbook. For example, you have today you bought McDonald's, right? You originally have $100 and then you bought McDonald's. You would say, okay, McDonald's date today, and then you would credit cash. Obviously, let's say this is a cash account. You credit cash. So you originally have $100. Now you use say $10 to purchase McDonald's. Your ending balance would be $10. So I'll show you a more detailed information in the future in a few minutes, but this is sort of what it look like. For simplicity, our class use the T account to serve as journals, ledgers. So if you see the commercial textbook, they use different forms, that's fine. T account is another form that we could use. So in this course, we're going to use the T accounts to serve as the general ledger. So this is the T accounts that's showing all different types of accounts that this guitar lessons has. And it has cash, accounts receivable, so on and so forth. This is September 30th, which is last month's ending balance. So in the part that we talk about different accounts and their normal balances, we know that cash has normal balances on the debit side. This means as of September the 30th, cash has a balance of $9,120. Okay, the same afterwards. You will notice some of the accounts have no balances. We will talk about it in later chapters, But now you just need to remember some of the accounts have no balances at the beginning, and we will talk about why they don't have any balances at the beginning of the month. But let's keep it in mind and wait for the future lectures. Another thing you can see from this general ledger is that this general ledger basically helps you to answer a couple of different questions. For example, what is the total debit side in the above ledger? That is just all the debit sides added up together, and the credit side of the ledger, all the credit sides add up together. You should notice that because when you do the entries, when there's a debit, there's a credit, and they have to have the same amount. So the debit sides added together should be the same as the credit side added up together in all your ledgers adding up. You can also answer the question of what is the total amount of total assets above, which means just the asset accounts that added up together, their balances added up together, and the liabilities are just the liability accounts added up together. Okay, so I have some solutions here which you could review by yourselves. The third technique we are going to introduce is the journal. A journal is more detailed record keeping of the transactions, which we have been talking about in chapter 2. So chapter 2, we talk about, for example, if we serve a client in September, that client pays the 1,300 he owes from September on October the 3rd, we would be debiting cash because cash increases in this case. We'll be crediting accounts receivable because our original ownership of the claim of the cash from the client is being paid off by the client. So you will see in this is one general journal entry here. It has several elements. It has the date, October the 3rd, right? We receive cash, so we debit cash. The reference number of cash, you have to go back to the chart of accounts, right? Cash has 111 as its account number, so it's 111, and debit 1,300. Accounts receivable has the reference number 113, then we credit this account for 1,300. This is a description. The last one, it says it's the accounts receivable collection. You could write your own description. There's no set format of it, but you have to express the idea that what is the transaction about. Okay, so this is one complete journal entries. So far we talked things right now. The first one is the chart of account, which serves as a map. We know what kind of accounts are available for us to use. We know the numbers of them, right? And the second one is the general ledger, which tells us the summarized information of the firm. And the third one we talk about is an entry which records each transaction. Now we have to talk about the relationship between a ledger and a journal entry. So what happened is that there is a technique in accounting we call posting. Posting is basically a sorting technique. For example, if you look at a journal entry or hundreds of them, and then I ask you what is your company's ending balance of cash right now, you can't tell me right away, right? Because you have hundreds of them, you have to summarize them by yourself. It's very difficult. So we do something called posting. We put the general journal, which is the journal entries, and sort them to different ledgers. For example, in this transaction, this is a different example that it's not guitar lessons, it's a random example. So for example, October 1, someone, if you know the language, right, it's obviously someone invested in the firm and giving you cash. So this would be sorting to, this one is the cash, and then the reference number is different, because this is, as I said, it's a random example. So it debit $15,000, you will see this would be copied to the ledger. You see, it's a sorting process. We sort all entries with cash to the general ledger that's designated for cash. So now you can imagine if I have 100 of them, I do 100 of them, I would know the balance because I put all the, say, October 1 owner investment. See this reference, it can be referred to the J1, it's the journal page 1. So it refers to J1. I can find this 15,000 from here, the debit side. And then because there's no beginning balance of this ledger, so the ending balance is 15,000. Okay, so this technique is called posting. We post any transaction that's related with, associated with cash account. We copy and paste all their amounts, the page number, and the explanation of that transaction to the page that related to cash. You can imagine there's another page that's designated for common stock. You will see, say, October 1 owners, you will see the same thing, October 1 owners investment J1, but it would be common stock, and it would be credit 1500, and the balance would be credit 1500. Okay, I mean 1000. So another example which related to the first page I show you is that, for example, you have a cash account number will be 111, and the beginning balance, say 5,000. It's a debit 5,000. And October the 3rd, you have received revenue from a client, 1,300, then you would debit 1,300 to it, and your ending balance will be the 5,000 plus the 1,300 will be 6,300. Okay, there should be a journal reference, say a J1 as the previous case, which is the first page of the journal. This technique is also called a cross-reference technique. You could basically refer, this is the account name. You could go back to here. You could see all the accounts with a reference 101 will be sorted to this page. And then all the reference to the transaction could be pointing to the page that contained the transaction. Okay, so this technique is called the posting. After posting, you will see all the information are summarized and become one general ledger. In the next video, I'll show you in a Excel spreadsheet how this posting process and the accounting process is completed. Okay, so I'm going to end this video here, and please wait for the next.